The final long-term assets that we'll discuss are intangible assets. Intangible assets are assets that don't have a physical substance, so we can't touch them. They are still very valuable assets to us. So we have rights or privileges from those assets. Sometimes the useful life is difficult to determine, but we usually require them for operational use. Examples of assets or intangible assets are patents, copyrights, licenses, franchises, trademarks, goodwill, right of use, any improvements, research and development are the big examples of intangible assets. We record intangible assets at cost, including purchase price, legal fees, and filing fees. When we record expenses against intangible assets, that is called amortization. And we record amortization expense against our intangible assets. That amortization expense is calculated very similarly to straight line depreciation. So total asset turnover for organizations. Our total asset turnover is net sales divided by our average total assets. This gives us information about a company's efficiency in using its assets to create profits. So we have 3 years of asset turnover for Starbucks and Jack in the Box franchises. So we see that Starbucks total asset turnover is decreasing. So even though they have acquired more total assets, they're not generating as much sales from them as they were previously. We're going to discuss the appendix and accounting for asset exchanges. So in the chapter, we looked at asset disposal and asset sale, but we can also exchange for a newer asset. So if we have a trade-in value on it. So machinery, automobiles, office equipment, etc., we're given a trade allowance for. So we need to account for that trade allowance. And depending on how that gets accounted for depends on whether the transaction has commercial substance. And commercial substance implies that our company's future cash flows will be altered because of this transaction. We're going to look at some examples. The first example is a transaction with commercial substance. So we get a new equipment of $42,000. We paid $33,000 and we had a trade allowance from our old equipment. The old equipment has a book value of $16,000 and has a trade-in allowance of $9,000. So we have this example here. We have market value of our asset received is $42,000. The book value is $16,000 and our cash paid was $33,000. So we have a gain or a loss on the exchange. We paid, however, because we had this trade-in allowance, we actually gave less cash. So we have cash and the trade-in of the old equipment that we would record. Here, an example we have with commercial substance. So this is that same equipment, and we're going to record the journal entry for that. So we have the new equipment we need to put on the books. We have a loss on exchange of equipment of $7,000. Then we need to remove the old equipment, accumulated depreciation, and the old equipment from our books, and record that we paid cash for the sale of that asset. So the loss is because we received a $9,000 trade-in even though our book value was $16,000. Now, if we look at that same transaction but with a gain, this is if we paid $23,000 cash with the trade-in. So we have equipment new, accumulated depreciation, and the old equipment that we need to remove from our books. We paid $23,000 in cash. That gave us a gain of $3,000 on the exchange of assets. So it depends on the amount of cash we pay and the amount of book value that we have left and the trade-in amount that we're given when we're exchanging pieces of equipment. And that is the end of Chapter 8.